Welcome to the Rapid Recap. I'm Sasha Evdokov. It is November 5th, 2015. Thank you for joining me this week. And if you haven't seen a Rapid Recap, it's really about teaching or giving you some insight to a lesson, in which case you can later apply to the market. So it's not just about stock picks. It's about getting better, improving, and just evolving your trading. So this week's discussion is all about risk management and money management in the stock market. And I'm doing this recap or this topic really because one of you asked for it. So Marcelo was the one that asked for it in one of the comments. Love to do a topic discussion. Now, in this topic or discussion, just because of the limited amount of time, I'm really going to concentrate and focus on one risk management topic and just give you an idea. It's just to give you a concept, because I could probably go into multiple hours on this topic and I could probably do a whole course on this whole subject matter. But the point is to give you some insight, to get you to think about risk management, to get you to think about money management in the stock market. So that way you can take that little concept, that seed, and continue to evolve it, to make it your own, to continue to grow it into something new, something different, and something that works for you. So that's really what my goal is today, because I just won't be able to cover all kinds of different topics and strategies. So my focus is going to really just simplify things for the masses, and just to give you some insight of how this business really works, of how you can reduce your risk, how you can manage that risk and manage your money in the market. So that's what we're really going to focus and talk about. So let's get into the groove. Let's get going. First, let's cover a few stocks, a few discussion on some stocks that are moving, acting, behaving, and some of the trades that I've been in. And then we'll get into this risk management. So let's get into the groove. And for me personally, I like to listen to some music actually when I do these recaps. It's actually on my headphones. And we just go ahead and speak and flow and go with the groove. So whatever it is that gets you in the flow, let's get going. So first things first, let's talk about Amazon. And Amazon was a huge win for us this week in terms of trading, in terms of investing, in terms of retirement accounts, for all the different spread strategies, shares that we've purchased. So looking at this stock, there's a handful of opportunities that you had, but take a look at the weeklies. We've been doing a stair-step pattern here, and the stair-step pattern really worked out really well. Now, typically I don't trade during earnings, so we do get out before earnings. And here, notice all the different opportunities. Now, of course, you wouldn't catch all these runs if you don't trade earnings, because you're reducing your risk, which is going to be the key in this week's discussion. But looking at, if we zoom in on the hourly just to see what happened, our earnings basically happened right here on this 23rd time frame. So this was where the earnings were, the stock popped up, and then slowly we had a slight little sell-off. So we had a slight little sell-off to this area right here. Now, your initial point was to really use this line, give it time to digest, and use this line as a stop, because here we have a large gap. So if that stock got back in here, that range could have been a huge risk. So you want to be mindful that this 20, 30 point bounce you didn't lose out on. So you would use that as a stop if the stock gapped up, because typically in earnings, look at what happens. That stock opens high, sells back off, and then continues to move. And this is, for this type of stock or this type of earnings, this is how it behaved. And sometimes you need to give it 1 or 2 days or learn to read how these move before taking a position. Now, in this case, it tended to work out really well. So what we wanted to do was get into the stock right here at the lows, because this was our first point. Our second point was right here. You can get into the lows and get, let's say, 100 shares to make things simple. And for conversational sake, let's say you got 100 shares. As that stock continues to approach these areas, you could take off 50 shares. Okay, so you reduce your risk 50 shares. And then as the stock powers higher or breaks this, this kind of confirms your move. So you just let those 50 shares ride, comes back, stock potentially bounces. You could add back another 50 shares. So this could be another potential opportunity to add. Or what you could have done is taken these highs right here and then added those 50 shares right here. So this could have been your adding opportunity for those 50 shares. So you continue this process in a stair-step approach, and this is just a 30-minute to give you an idea. This would be for a very active person or a very active trader. If you weren't as active, the way that you could have done it or the way that you could have approached it was simply to nibble. Let's just say you got your 100 shares right here. You got into that stock right there, allow it, continue to run, and somewhere around this region, you take off 50 shares. Okay, so now you have 50 shares remaining, and you let the rest ride, and you continue moving your stop higher as that stock continues to move up. So that was another way to do it. But Amazon here was acting, behaving, just moving really well. And you can see here, this is the daily. This was the break. And from that breaking point, even if you entered a little bit late, you basically had a 40-point gain in just a week here, pretty much a week and a half time frame. Okay, Tesla also had earnings here. We had a nice pop, but looking here, it has a lot of weak overhead supply. So if you're going to get into this one, just nibble a little bit and then watch it closely because it's a little overextended, especially if as you start looking at this monthly chart, you can see that we've been consolidating kind of sideways here on this chart. But nevertheless, it's a powerful company. So just watch it closely how it acts and behaves. Be patient. Wait for the right setups. Facebook also had earnings popped, but this one didn't move like Amazon. So if you look at it here, we had a pop, slight little move to the upside. And then after this move to the upside, it went back into the gap. So your point right here went back into the gap, made a little bit of a low here, came back, got over this line right here, and then we kind of hanged around right there in this level, bouncing at these points. Now with this stock, this is looking at it really on the 10-minute short time frame. So that's a short time frame. So do you need to get in it right this second? No, you don't. But looking at it on a weekly, you can see that this stock on a weekly is moving, acting, behaving just the way it should. There was your entry point. Here was another entry point. The volume right here, we're on the weekly. We still have 1 day to go, so it'll probably get to about 165, 175. We'll see how things move. But here, looking at this one, you had a few opportunities. This was a little bit of a bad sign right here because we came into the lows with that major sell-off. So this is one of the reasons why you always want to peel shares off into strength because you never know when these things happen. You don't know when these stocks are going to pull back on major volume. And when they pull back hard. They don't pull back soft. They pull back hard. GoPro, take a look. See what happens. And these companies, when they start selling off, they continue moving lower. And with GoPro, there was a lot of hype that went into this company, great cameras. And I talked about it because really the main shorting point for this company was right around this level right here. There was a lot of opportunities. You could have shorted it here. But by now, this stock is already starting to level off just because that short run is coming to a close. Slowly, meaning that short run is extended to the downside. So the remaining move is not as much as it could be, or the potential is a lot less. So, and the reason I say that is because some of these companies, they'll continue to move like Groupon, even though this one was at 22, 25, and it's a popular website, but some of these companies, look at them, even though they're popular, that doesn't mean the stock price is a great investment or the big guys want it. So this one's at $3. And when you look at GoPro, I know I'm comparing apples to oranges here. But when you look at it, this one was also at $95, and now it's back at $24. So don't get wrapped into the hype of what people are saying. Trade the trade. Don't trade the market. So even though the market, if we look at today's market, was down about a point here, or the spiders here, when we look at it, just a tenth of a percent. It wasn't moving, but when you look at some of the companies, Amazon here is up basically $15, and this wasn't even on an earnings play. Taking a look at Apple here. Here's Apple. It's struggling to get over this one price level right here, and this is really what's causing it some trouble. But if it gets over that on volume, this would be the entry point. Now, here's the thing about risk management and money management. We basically cleared it a couple days ago, and then we dropped back out under it today. So for me, the way I look at it is that was a loss. So you get in it, stock comes back a little bit higher, starts selling off, not continuing, no follow through. Sometimes you hear me talking about second day follow through. And if there's no follow through of the second day, it's acting weak, then what happens? Well, that stock's rolling back over, you're out. That means you might go into it a second time here or a third time. So it may take you 3 or 5 or 7 times until that stock breaks out. But you're waiting patiently, and you might be getting stopped out multiple times until that trade is profitable. And that's just part of the business. It's called risk management, money management, being patient. That's what this business is really all about. So we'll get into that here in a second. Hawaiian Holdings here. This one's been breaking out really well. So here's the descending trend line. Moving, acting, behaving exactly as it should. It was in the critical charts, so looks good. Definitely take profits into strength here. Price line. Same thing here as we look at this resistance line. Entry point was right here at around the $1,400 range. Stocks holding up, good 60-point gain, even though today we're down $6. But remember, for these big stocks, $6 little retracement or pause, that's even a 20-point little pullback on a $1,500 stock is not a huge deal. If it was a $100 stock and you had a $5 retracement, that's pretty big. McDonald's, we talked about it a few weeks back, still holding up well. And when a stock's holding it up, especially after popping higher for one of these kinds of companies, kind of one of the more stable companies, that's a good sign because it's not selling off. It's not selling off huge. So it's holding up well, and just use these lines as a stop, or if you want to give it a little more room right here. If you got in it on the break, lucky you, but those were earnings. So probably chances are you just either got lucky, but if you got in after the earnings, then you might want to use that 109.82 as your stop, or even the lows of that day of 10/22, and that would be the 108 about 8. So 108 price level. So be mindful. IBM continues to move lower, just as we talked about. The stock just continues to move lower. 122 would be a good price point for it to get to. We'll see if it gets there, but continues to move lower, just like CMG, even though we had a slight little pop today of $1.46. I mean, since this break here, we've basically went down about 92 points. So those are the stocks I wanted to briefly touch on. So let's talk about risk management and money management in the stock market. Mostly, let's talk about risk management, and I'll give you what I can give you here in the next 15, 20 minutes, and just talk about some concept about risk management, because I know this business is really all about risk management in the end. It's about money management. It's about being disciplined. There's a lot of factors. It's about the probabilities, and you can be very number oriented about this business. Or you could be a little bit more spiritual about it. You could be a little more emotional, intuitive about it. Whatever method you choose is up to you, but you still have to manage your risk. You have to understand how stocks act and behave and what's possible. So using a simple example is, let's just take CMG for the time being, just because we have it up right here. Just using this stock as an example, if you're driving a car, and let's just take this run for example. If you're driving a car and you're driving it fairly normal, at normal speeds, then you're making progress and you're moving okay and you're getting to your destination. But as you start accelerating really fast, as you start moving very quickly, eventually something's going to happen. It's kind of like those motorcycle riders that ride on one wheel on the highway going 80 or 100 miles an hour. So as you're going really fast, something may happen with time. If you do that long enough, eventually something is going to happen. Either your tire blows out, somebody merges into you, whatever it is, you get tired, you slip, the wind catches, something's going to happen. And then you have to slow down, or you fall, and, the worst case scenario, you could die. So there's a lot of danger behind it. And this is where a lot of emotions happen in the stock market, is right there at this point, because we have this very happy moment of driving, going, getting to our destination quicker, making more money. And then weakness comes in, we sell off, and this is where all the trouble happens. And most people don't understand this because they assume or think that stock is going to continue moving higher, but it's not always the case. The stocks don't move in a straight line. They pull back, they retrace, and that's healthy. And then they'll continue moving, and then again, they'll sell off and retrace. So because you have this wave pattern and you understand that now they don't move in a perfectly straight line, you need to be taking money off the table. So there's a few different ways to do that. And I'm just going to share with you one of the easiest ways that I can get the point across, and then you can slowly modify it. Of course, as you get more advanced and you have multiple trades going, you have options going, there's a lot of different ways to hedge meaning protect your risk. So protect your money, protect your account. So you can hedge it with puts, you can hedge it with option spreads, you can hedge it with other investments. So there's a lot of other ways to do it. But I want to share with you one of the simplest and easiest ways. So let's just take the run of 624 to, let's just say 724 for conversational sake. So let's say the stock moves from 624 to 725. Let's say 625 to 725. There we go. So in this example, you can see that stock right here. So this is the one we're going to be discussing just for the time being. And in this case, this stock is moving to the upside. So let's just say you got in at 625 and you purchased 100 shares. So that was your investment. That was your trade. You got into it with 100 shares. So now you're in the trade. And now if that stock goes up $1, you make $100. If that stock goes up $5, you make $500. So in simplicity's sake, every time that stock goes up, you're making a huge profit. You're making a one-to-one kind of profit, because for every dollar that the stock goes up, you're getting $100. For $5, you're getting $500. So if you're looking to protect your investment, you need to be constantly doing one of two things, or both things. You need to constantly raise your stop, and people talk about this. Why don't I just continue to raise my stop? As that stock continues to move, I'll continue to raise my stop, and then if that stock hits it at this point, I would be out. So this would be my out point, because I'm continuing to raise my stop. Now in this situation, this would be a great way to manage your risk, because what you're doing is you continue to move. And here in this situation, what we have is, let's just say 100-point gain, or let's say 122. So here we have 122-point gain, and we have 100 shares. So what this would bring me to $12,200. Okay, so $12,200. So that would be my profit right here on that investment. 122-point gain, 100 shares, that's what I have, $12,000 gain. And then the minute it hits this point, I would be out. Okay, so right here, I would be out. This is right here. This would be the typical area, or the typical mindset of most people, is that they'll continue raising that stop. And that's a great way to think about it, because you're constantly moving your stop point or exit point. Now, unfortunately, this isn't the best risk management. And the reason I say that is because you're still fully invested and anything can really happen in the market. You can get major sell-offs, your emotions start to take place. So the better approach, the way that I like to get people started into thinking about risk management, is to always peel some shares off. So if your stock continues to, let's just talk about it from here. If you were doing the same kind of concept from this level right here, so we're going to talk about from this level. So let's say you got into the stock here and you got in it right around this point for whatever reason. So here that stock continues to move and you have a stop, but that stop is already down here and your entry point might be over here. So you're almost at breaking even. And here's where things become a huge problem, is when you start moving, let's take this move. As you start moving in this range and you start moving your stop up and up and up, there's certain times where you get a major one-day drop like this one or like this one. So you get these major drops all in one single day. And you're saying, well, that's CMG, it's big, it moves fast, but there's a lot of companies that do this. It could be for whatever reason. I mean, you take Facebook, which doesn't move as big as CMG. So here, look at these drops. Look at these drops right here. Okay, so let's take Alibaba. I could pick any stock. It doesn't matter. They all have major drops. So if you take a look at the longer term right here, this is where everybody here was all excited about this company. Then look at this major drop right here. And the problem is we get too emotional, is if we got into this stock right here, and then that stock starts rolling over. And then we start looking at it and saying, well, at least we're still even. And then this stock drops. And then you're still holding on to it. Well, it can probably get back up here. Up here. But then it rolls over and we continue moving lower. So that's what happens with stocks. And then you're underwater on a major position. So, or you start adding to it and you doubling your shares into it. And that's really where the problem lies. So instead, the better approach is to peel some shares off, meaning you take some profits into strength. So let's just use Alibaba as an example since we're here. So let's just take again our 100 shares of Alibaba, and we have 100 shares. So we purchase it for conversational sake. Let's just say $60 over here at this level. So buy $60. Okay, so now as we start moving up, so let's take a look at this as we're moving up. So here, this stock moved up, let's say 6 or 7 points. 7 points. So on 7 points, 7-point gain on 100 shares, you make $700. Okay, 7 points, 100 shares, $700 in profit. So what you can do is take half off. So after you get that 7 points, you take half off. So out of that 100 shares, you take 50 shares off. So taking profits, you take 50 shares of profit, and this would be your 7 points that you gained. Your profit amount now, 7 times 5 is 35, so 350. So your profit now is $350 from that 50 shares. So that's your profit. Now you have 50 shares remaining. Okay, so you still have 50 shares remaining that you can allow that stock to continue to run. So with those 50 shares now remaining, you let that stock and you continue to allow it to run. So now you have another 14 points, 15 points. So let's, for simple sake, let's say 12 points. So you get 12 points gain. Okay, so 12 times 50. So take out a calculator here. 12 times 50, you get 600. So now you get an additional profit, 600. So now you have $600 in profit plus your $350 in profit. So this puts you at $950 in profit. So now you're in profitable position of $950. But if this stock drops back down to $70 or your original entry point, let's just say disaster happens. A huge disaster happens to that stock, and this stock continues to move lower all in a single day. What happens then is now you don't have that $600 of profit. This additional profit is gone. So instead, you still have your $350 in profit plus your zero profit from the remaining shares because you exit at your entry because you continue moving things up. Now, as you make this more complicated, what you could do is do this on a more complicated scale. So let's say you have more shares or 100 shares, doesn't matter. You do it in quarters. So as that stock goes up, for every $2 that stock goes up, you take off, let's say, 25 shares. Okay, the stock goes up another $2. You take another 25 shares. Another $2. You take another 25 shares. And you continue this process and continue taking your shares until you get pretty much until you've taken all your profits. Now, the remaining, once you get to, I'm writing this out, so if you want to take notes, once you get to 75 shares gone or taking profits out of 100, so this means you basically took 75% off the table. You let the remaining shares or the 25% of your original position ride. You let it ride. So now, as you've taken all these profits, okay, if you've taken 75% of your position right here off, the remaining, just let it ride. Just let it ride, and it's free money, okay? And if it comes back right here to this level, you're out. You're out. That's it. No negotiation, nothing, no hoping, waiting for it to potentially get back up higher, because these things can come back, whipsaw, and they can come back right down here, no problem. And you're at the 70 level, even though you took profits here. But at least this gives you a $10 cushion. $10 cushion on a, let's say, $25 share or 25 share count. So you got 25 shares at $10. So this would drop you back down at a negative 250. Okay, so you're at negative $250 on that. But remember, you're taking $6 here in profits, and this one would be even more because remember, it's $2 going up. So this is $2 that it went up. Then this one actually went up $4, and this one actually went up $6. So in total, you made $10 plus the other $2, so that's $12 that you made, a $12 run times, your share count. So you calculate it and get the result. So let me get a second. Let me calculate it for you, and I'll give you the result. All right, so I did those calculations for you here while I pause the video, and basically here's all the calculations for you. So you have $50, $100, and $150 with all your profits, and your total profits here, you basically have $300. So from a simple 100 share position, because you have 150 plus 100, that's 250, plus the other 50, that's 300. Simple, basic math. Now, remember, if you made this a lot larger or if you traded more shares, you can always add an extra zero on this. So now you're starting to take more profits. Okay, so let's just say you continue to take profits and you continue to raise your stop. So now you're taking profits of $500, $1,000, $1,500. So now you start continuing to add things up more and more. And as you continue to add these things up, you basically are just taking money off the table. And this is how you continue to reduce your risk. Now, this is one of the simple strategies to apply, especially if you're brand new, if you're a beginner. Now, in terms of your stops, where do you place your stops? Well, let's just take Amazon for conversational sake again. Let's just take a look at this one. I was watching to add to this position actually on the breakout. Okay, so I'm waiting for this breakout, and you can see it started to almost break out right here again for another time. And the reason I'm using this example is just because I'm very familiar in this. We heavily loaded in this trade, so very invested in it. So here I'm waiting for the break, and you could say, okay, now, for me personally, we didn't add here, but let's just say you got caught a little bit early right here at this point because you're watching it, or even let's just say right here, you're looking at the stock and you were adding it right here at this point. So in this situation, you're looking to add, okay? So you're looking to add right here at this point after the breakout because we have resistance here, we have resistance here. So these are some of our resistance points. The stock is starting to break out here. So I went ahead and let's say I added at, I gave it a little room. So here was 655.35. And normally for these stocks, I would say let it pop an extra $2 before you add because they whipsaw around because they're already heavy price. So let's say I would get in at 657. That would have been my entry, or 656. And that's exactly why you do this, because they'll roll back over in a dollar. But let's say you got in early. Let's say you wanted to get in early. You were a little antsy. So let's say you got in at 655, 69, or 78 right here. And then you got in and this stock goes up $1.35. Okay, and let's say your risk management was $2. So the stock goes up $2. For every $2, you take some shares off. But this stock now went back under. So within just, let's say, 20 minutes, 15 minutes right here, the stock rolled back over. And your stop was also $2. So from here, if you go down, you didn't fully make $2, but let's say it hit $2. If it hit $2, you would be completely out. And yeah, that's a losing trade. You're taking a hit on that $2. So you took a $2 hit of your 25 or 100 shares, whatever it is. So you took your hit. Okay, the next time it happened again, let's just say it happened again a second time. You take another $2 hit. Okay, so that's $400. So let me break this down on a risk management profile for you. So if we take a $2 hit on a stock, especially as big as Amazon, so a hit or a loss, just to write it out in case you want to take notes. So if we take a $2 hit on 100 shares, this basically is a loss of $200. And if we do this loss 2 or 3 times, let's say 3 times, just for conversational sake, just to show you how things work out and how things really balance out. So let's say $3, and I didn't plan this example at all beforehand. So $3 times your $200 loss, or no, 3 times your $200 loss, you get $600 in losses. Okay, may sound like a lot for many of you, and that's okay. We're just using it for numbers' sake, and you can use this example for your own purposes and apply it to other charts, stocks, and so on. The math is the same. And then what you do is you look at the stocks, how they move, how they act, and how they behave. So in this stock, the move was $32. Okay, so the move was $32. So here I'm risking $2 hit 3 times, which is technically a $6 hit, to gain 32 plus. Okay, so it potentially could go even much more than $32. Okay, so I'm risking, and that would be a late entry. So right here, that's a $30 gain right there. Okay, if you got in it a little bit earlier, it could have been a 45 point run. Okay, so you're risking $600 for, let's just say, for conversational sake, again, you got your 32 point gain, times 100 shares. So now you have your $3,200. So you can see that in this situation, taking $600 in losses but gaining $3,200 is a huge win. Of course, you're going to have some losses from time to time, but look, you're risking $600 to potentially make $3,200. And that means you can really make 3 or 4 of these mistakes, maybe 5 of these mistakes if you're really cautious. 5 times 3 mistakes, 15 mistakes, and just have one solid winner. Okay, now of course you will be taking profits into strength. So maybe this is 2,500, but really there's a lot of mistakes that you can be making as long as you're taking profits into strength. And you can do the math how you would calculate this out, but let's just say for every $2 that stock moves up, you take some profits. Okay, so you're taking some profits, and then continues to move up, you take more profits and more profits until you get to, let's say, 75. If you're just starting out, I would say 75% of your holdings. So if you traded 100 shares, you want to be left with just 25 shares and let the rest ride. If you're more experienced, if you're good at technical analysis, you can let this go with maybe, let's say, just 25% profit taking. So you can allow that stock to continue to run and you only take profits on 25%. That means you let 75% ride. Now, as that stock continues to move higher and higher, you want to take more and more profits. And the reason for that is because things get overextended. So looking at, let's just take Apple because it had a good move and, the extension and so on. So here in this example, you can see that this stock ran from here to here. We had a run of 83 points. And by the way, from here to here, we had basically 79, 80 points as well. So the A to B, B to C, C to D pattern for those of you that took the technical analysis course. So in this example, here's what I want to share with you is, let's say in this example, we started with 100 shares right here. Okay, we started with 100 shares. Okay, as that stock continues to move higher, I may take 25 shares off. Okay, so I'm reducing 25 shares. Then again, I may take 25 more shares off. Okay, I'm selling. I'm getting rid of these 25 shares. So now I have 50 shares remaining and 50 shares gone. As the stock continues to run, notice this huge run to this upside. I may take another 25 shares off right around this area. Even if I got it here, that's fine. That's fine because it still had a massive run right here. So even if I got it here, another 25 shares off because the run is extended. It's too far. You're going too fast. And when you're going too fast, it's going to pull back eventually. And then I let the rest ride. So now my stop could be right here. And that stock starts to roll over. I hit that stop right here and I'm out. And I took these profits, I took those profits, and I took these profits. And then I closed out the remaining 25 that was remaining for a break even right here because I'm allowing it to run. Now, if you want to get more technical, what you could do is start taking 10 shares off, then another 10 shares, and then 5 shares. So you start reducing how much you take off. But looking at the bigger picture, that's how you do it. That's how you continue to increase your profits is by taking things off the table. If you don't take things off the table and you wait and you had, because here's what a lot of people do. Here's what a lot of traders do, and I did it myself, and I had a lot of mistakes doing this, was I would get into this breakout point because I understand some basic technical analysis, and let's say I got in 100 shares. I'd allow that stock to continue. It starts to come back. I'd say, okay, now it's going back up. Wonderful. I hold that stock, and then I get too emotional. I'm saying, oh, well, it'll go back up. It's Apple. And it continues to go lower, and because I get nervous or frustrated, I sell my position right here, negative 100 shares, and it's actually below my entry point. It's lower, and I'm at a loss for whatever the amount. Well, a loss of 5 points giving me a loss of $500, or if you're trading 1,000 shares, $5,000. So again, that's how you really don't want to trade. Instead, for simplicity's sake, start out the way that I explained and outlined here, is to go step by step. As that stock moves higher, as that stock continues to run in your favor, you're taking money off the table. And you don't use hard moving trailing stops that are only that. Instead, you want to always be taking money off the table. And until I got this concept, until I understood this, I wasn't profitable. I was not profitable in trading until I understood this concept, because you have to take money off the table. And as you trade larger, 10,000 shares, 20,000 shares, the same thing. You'll take 1,000 shares or 3,000 shares. And it doesn't matter if you're wondering about how many shares, when to take profits. It almost doesn't matter how many shares you take profits, just as long as that you do. If you're brand new, just start with half. Just take half off the table and then let the other half ride. And that's just because, I say half, just because it'll keep your emotions out of the game. Okay? As you get more comfortable, you could take a quarter off. Okay, so, and if you're trading options, if you're trading spreads, if you're trading calendar spreads, iron condors, if you start with, let's say, 3 calendars, okay, you take 3 calendars and then you take one off and you sell one for profit, okay? Then you maybe sell another one, okay? So now you got one remaining and you let that one ride and see how things go depending on price movement and your theta and other things. But you're trading it the same way. You're trading it the same type of environment because you're letting things run. All right, so hopefully this gave you some insight. I mean, we could go in depth into more concepts about risk management, and I'm actually setting up another area here in the studio to potentially show you my hands and drawings, and that way maybe I could explain these concepts a little bit more on pen and paper where it makes a little more sense with drawings. So maybe we'll get that set up here soon. But really what you want to do is just constantly take profits in the strength. And that's just one of the simplest and easiest ways to explain that risk management. Okay. Money management, as you're managing your cash flow, that could be a whole nother discussion, but really the same concept really applies, as you're taking money off when you're in your trading account. So as you're making profits, you're taking money off. So you apply the same kind of thing. Maybe we'll do another video more about managing the account funds on another video. But as far as trading as that stock is running and moving, this is a good starting point for many people. If you have no rule or if you have no strategy for risk management, start with this and then you'll evolve it. Okay. So hopefully this made sense. I hope you've had a great week, and it's been a great week here so far. I did some raking, and we'll be going out for dinner, just taking care of a lot of other things, going to get a new desk here as well for the office. So we're going to make some changes. We'll be doing the podcast for you guys as well over the next month or two. I've been focusing on also a lot of the options course. There's still 1 or 2 more things I need to take care of on the business side to launch 1 or 2 of the other books that I've written. They're shorter books, and get that out. But really my main focus is the options course, and hopefully January, February time that'll be released. It is absolutely huge. It is big, and it takes up a lot of energy. So that's my main focus. That's what we're doing. That's what we're talking about. Education. After that course, we'll got the how to enter, how to manage your position, how to exit your trades. All that main course is going to be put together. It's going to be basically just me talking a recap, kind of like a 15, 20-hour recap, maybe 10-hour recap, however long it's going to be. Just kind of sitting and talking to you like a friend, explaining to you how things work, putting all those things together. You'll have to have the other courses kind of to understand things, because it's going to compose and put everything together for you. And that'll really be my, I would say, probably more of my final major course to create as far as trading goes, because there's not a ton of more knowledge that I can really produce to that high level. If something else comes up in the future, then we may go ahead and make it. But really beyond that, we'll be making a lot of other free videos, free trainings, free material, a lot of other cool stuff, but a lot of it will be just absolutely just to contribute, to educate, and give more to your learning. So enjoy the rest of the weekend, or the rest of the week, the rest of the weekend. Trade your stocks well, reduce your risk, manage your risk, and have some fun. Go out, enjoy yourself, and make a life. We might be going to a cheese festival, so that might be our thing for this week. So hopefully you go out, enjoy whatever you have around your area, make a friend, contribute to someone else, and have a good time. All right, thanks again for joining me, and I'll see you next week.